This video, I would like to talk about dollar cost averaging. Dollar cost averaging essentially is an investment strategy where you invest a fixed amount of money regularly into an asset, over time, regardless of the price of the asset. You keep on investing, and you do that at regular intervals. It might be monthly, it might be quarterly, whatsoever. The aim here is to reduce the impact of volatility and to avoid the pitfalls of trying to time the market. So here is a detailed overview of dollar cost averaging. I want to consider the key concepts of this particular investment strategy. Number one here is the definition and, of course, the purpose of dollar cost averaging. Dollar cost averaging, as I told us earlier, involve investing a consistent amount of money, at a regular basis, on a regular schedule. It might be on a monthly basis, it might be on a quarterly basis, into a specific investments such as stocks, such as mutual funds or exchange traded funds. The aim here essentially is to mitigate the impact of volatility by spreading, spreading out your investments over time, and avoiding the risk of investing a lump sum of money at the time when the market is at its peak. So it helps you to pick the bottom, to invest at the middle, and even sometimes investing at the peak. You avoid the mistake of investing a large amount of money at the peak, which might result in a huge loss if the stock suddenly plummets. And not only that, we have number two. How does dollar cost averaging works? How does it work? Usually, it involves regular investments. You set up an automatic investment, of a fixed amount, of money into your chosen asset class, or fund, and you do that at a predetermined interval. You do it regularly. Not only that, we equally need to consider price fluctuation. When the price is low, your fixed investment buys more of the shares you want to buy, or more of the units of the shares you want to buy. And when the price, when the prices are high, you buy a fewer units of the shares involved. So over time, these averages out the price of the investment or the price of the share, as the case may be. It's equally, taking into consideration reduce impacts, of timing risk, reduce impact of timing the markets. So by investing consistently, you reduce the risk of making poor investment decisions, based on market timing. You tend to eliminate the impact of investing in the market at the wrong time. Number three is benefits. We want to look at the benefits of dollar cost averaging. So in this case, you have it tends to reduce timing risk. Dollar cost averaging reduces the risk associated with investing a large amount of money, at the wrong time, such as at the peak of the market. You avoid that kind of mistake, completely. And number two is it involves simplicity. It incorporates a level of simplicity into investing. In this regard, the strategy is straightforward and can be easily automated. It could be kind of placed on automatic mode every month or quarterly, as the case may be. You simply invest that fixed amount of money, regardless of the price the stock or the asset is selling at. It equally involves a kind of a disciplined approach. In this case, it encourages regular investing and adherence to long-term plan, avoiding emotional decision making. That discipline inculcated into this particular process will help you to avoid error, mistakes, emotion in the investment strategy, in the investment process completely. Number four is the drawback. If you examine the benefits which involve reduced market timing risk, simplicity as well as a disciplined approach, we also want to look at the pitfalls, the drawback, the disadvantages of dollar cost averaging. There's that, potential for lower return. You have a relatively lower returns compared to other investment strategies. In a consistently rising markets, dollar cost averaging might result in lower returns, compared to investing, a lump sum upfront, particularly when the market is down at the bottom. So if you buy at the peak, you discover that your returns will be lower. Not only that, number two is there's no market timing advantage. The market timing generally is not encouraged, but if it is done right, you stand to benefit if you could, if you could accurately, predict and time the market. Then of course I believe you could equally, gain tremendously from it. So dollar cost averaging does not take advantage of market dips, for larger investments, which could be beneficial in a volatile market. If you are able to detect, determine the bottom of the market and you invest a large amount of money, then you stand to gain tremendously. But when it comes to dollar cost averaging, you don't take advantage of the market dips. You simply buy, put in a specific amount of money, regardless of the fact that the market is at its bottom. And not only that, you have transaction cost. Frequent investing can lead to a higher transaction cost. Each time you buy, it attracts commission. And as you buy frequently, over time, the commission alone will eat into your profit at the end of the day. I want to look at the strategy, that is involved in this approach. The strategy approaches when it comes to dollar cost averaging. In this case, number one, you determine the investment amount. You decide on a fixed amount you are going to invest regularly, and then you inculcate that into your budget. This amount should be consistent, and of course, it should be something that is manageable. Number three is choose, an investment interval. You may choose to invest monthly. You may equally choose to invest quarterly. Whichever the case, let it be something regular. And they should you equally, incorporate consistency. Consistency is key when it comes to dollar cost averaging. As long as you are consistent on either quarterly or monthly, whichever the case may be, make sure that you do that regularly and consistently. Number three is, select investment vehicle. In this case, you may apply it to index fund, you may apply it to mutual fund, you may apply these strategies to exchange traded fund. You could equally use it, to buy securities. So you select your vehicle. Number four is, automated automated kind of investment. You automate your investments. So you set up an automatic contribution to streamline the process and ensure, regularity, to ensure discipline. Once the process is kind of automated, then of course, it takes out, human intervention in the entire process. Number five is monitor and adjust. You need to, periodically review your investment strategy and the performance therein. You adjust wherever necessary, or the frequency of your investment if necessary to align with your financial goal. Regular rebalancing and adjustment is very important when it comes to investing. You look at the portfolio performance and see what to buy more, what to hold, and even what to reduce or sell off completely so as to be able to meet up the targets or the goal you set for yourself as an investor. So who is this particular strategy for? Is it meant for you or is not meant for you? So dollar cost averaging is suitable for long-term investors. You are a long-term investor, and of course, this particular strategy is suitable for you. Have a long-term horizon, then of course you could apply it because it will mitigate the market timing risk. It eliminates market timing risk. It is also good for beginner investors, individuals who are just starting their investment journey. You could adopt this particular method because it is a kind of systematic approach. You don't need to think too much about it. It's something you could just set a particular amount of money, pick your interval, and you are good to go. So it's good for building your portfolio. Not only that, it's for those who want to contribute regularly to their investments accounts. You simply, give an instruction to your bank to set aside a particular amount of money every month or quarterly, as the case may be, into your brokerage account to enable you buy, whatsoever investment you want to buy regularly. The investors who have a source of income, if you have maybe you're a salary earner, it's okay. You could dedicate a particular percentage of your salary, 10%, 20%, the case may be, into your investment. And as you do that regularly, you discover that you're going to benefit maximally from dollar cost averaging. It's a very good investment approach. Despite the disadvantages we come across, the advantages are equally there. You are a beginner, you are a long-term investor, you are a regular contributor. It will go a long way in helping you to be able to benefit maximally from this particular investment strategy.